You open your banking app, you see a number. It says you have $4,000. That number feels solid. It feels like something you could reach into the screen and touch. But here is the strange part. That money is not sitting in a vault somewhere with your name on it. It never was. So where did it actually go the moment you deposited it? Think about the last time you walked into a bank. You handed over cash, or you tapped a card, or you set up a direct deposit from your job. A number changed on a screen. You walked away feeling secure. But behind that simple moment, something much stranger was happening. Your money left your hands and entered a system that most people never fully understand, even people who use it every single day of their lives. Start with the vault. You have probably imagined one. Steel walls, stacks of bills, maybe a big circular door like something out of an old movie. That image is comforting. It is also almost completely wrong. Banks do keep some physical cash on hand, but it is a tiny fraction of what they actually hold in deposits. The rest, it gets put to work almost immediately. Here is the mechanism. When you deposit $100, the bank does not just let it sit there. It keeps a small portion in reserve, and it lends out the rest to someone else. That someone else might be a small business owner opening a bakery. It might be a family buying their first home, and the bank charges them interest on that loan. That interest is how the bank makes its money. Your deposit becomes someone else's opportunity. But here is where it gets genuinely strange. When the bank issues that loan, it does not physically move your original $100 into someone else's account. In most modern banking systems, it creates new money, not printed money, digital money. A new number appears in a ledger. The Bank of England confirmed this directly in a widely cited 2014 paper written by economists Michael McLeay, Amar Radia, and Ryland Thomas. They explained that commercial banks create the majority of money in modern economies simply by making loans. Most people assume banks only lend out money that already exists. The reality is closer to the opposite. Lending creates deposits, and deposits create the illusion of more money in the system than there actually is in physical form. Sit with that for a second. Your bank statement is not a snapshot of coins sitting in a box. It is a claim, a promise, a number, in a vast, interconnected ledger of promises stretching across the banks, cities, and countries. Almost nobody thinks about this while they are buying coffee or paying rent. Why would they? The system is designed to feel invisible. It is designed to feel safe. And most of the time, it is safe. But the safety comes from something surprisingly fragile. This fragility has a name. Economists call it the bank run problem. It was formally explained in 1983 by two researchers, Douglas Diamond and Philip Dybvig, whose model became so influential that decades later, in 2022, Diamond shared the Nobel Prize in Economic Sciences for this exact work. Their theory laid out something unsettling. Banks only function because everyone believes the bank can pay everyone back at once. But it cannot, not really. If every depositor showed up on the same day and asked for their money in full, the bank would run out almost immediately. The whole system relies on the fact that most people will not do that at the same time. Why doesn't the whole thing collapse constantly then? Trust. Pure, as engineered trust. Governments back deposits up to a certain limit through insurance systems like the FDIC in the United States. Central banks act as lenders of last resort, stepping in during a crisis to keep cash flowing. These backstops exist precisely because the Diamond-Dybvig model revealed how easily panic alone can topple an otherwise healthy bank. Confidence is not just a feeling in the system. It is the actual infrastructure holding it together. Now go back further. Long before ledgers and apps, banking began with something almost embarrassingly simple: gold. In medieval Europe, people who owned gold would deposit it with goldsmiths for safekeeping. The goldsmith would hand back a paper receipt. Over time, people realized they could trade those receipts directly instead of retrieving the gold every time. The receipts became a kind of early currency, and the goldsmiths, watching piles of gold sit untouched for months, made a discovery that would quietly reshape the entire global economy. They could issue more receipts than they had gold. As long as not everyone asked for their gold at once, nobody would notice the difference. That single insight is the seed of modern banking. The Medici family in 15th century Florence built one of history's most powerful banking dynasties on refinements of the same idea, extending credit across cities and even funding kings, all built on a foundation of trust rather than a room full of coins matching every account exactly. The tools have changed. The core mechanism has not. For centuries, this expanding system still had a leash on it. That leash was gold. Nations tied the value of their currency directly to a fixed amount of gold sitting in reserve. In theory, this kept things honest. A country could not simply create endless money out of nothing, because every unit of currency was supposed to correspond to something physical locked away somewhere, but that leash also limited how much an economy could grow because it limited how much money could exist in total. That changed permanently in 1971. President Richard Nixon announced that the United States would no longer allow dollars to be exchanged for gold at a fixed rate, effectively ending what remained of the gold standard. Overnight, currency around the world became what economists call fiat money, value backed not by a shiny metal in a vault, but by government decree and collective trust. This moment is often treated as a footnote in history classes. It was not a footnote. It was one of the most significant shifts in the entire concept of money, and it is the direct reason your bank balance today is pure digital agreement rather than a claim on physical gold sitting somewhere in a mountain. Does that unsettle you a little? It should, at least briefly, because it means the number in your banking app has no anchor to anything physical at all. It floats entirely on confidence, confidence in your government, confidence in your bank, confidence in a system of interlocking promises that has, so far, mostly held. So when you deposit your paycheck today, you are participating in a system with roots stretching back 600 years, a system built not on certainty, but on calculated, managed risk. Your bank keeps a reserve. It lends the rest. It profits from the difference between what it pays you in interest and what it charges borrowers. Multiply that across millions of depositors and millions of loans, and you get an economy that runs in large part on money that only sort of exists. Does that sound unstable? In some ways, it is. The financial crisis of 2008 exposed just how quickly trust can unravel when banks take on too much risk with too little real backing. Banks had made loans against assets that turned out to be worth far less than everyone assumed. When that assumption cracked, the whole illusion of solidity cracked with it. People lined up outside banks in some countries for the first time in decades. Institutions that had stood for over a century collapsed within weeks. It was a brutal modern demonstration of the exact fragility Diamond and Dybvig had described mathematically decades earlier. But in other ways, this system is one of the most quietly effective inventions in human history. It lets a stranger's small deposit become a mortgage for a family across town. It turns idle savings into new businesses, new homes, new jobs. Money that just sat there would do nothing. Money that moves, builds things. Consider what life would look like without this mechanism. Imagine every dollar had to physically exist before anyone could borrow it. No expansion of credit beyond what was already sitting in vaults. Growth would slow to a crawl. Entrepreneurs would wait years to save enough capital before opening a single shop. Home ownership would belong only to those who could pay in full, upfront, in cash. The economist John Maynard Keynes argued in the early 20th century that this kind of frozen, overly cautious system would strangle economic growth rather than protect it. His broader insight still shapes central banking today. Sometimes controlled risk, managed carefully, produces more stability than rigid caution ever could. Now think about interest rates, because they are the quiet lever behind almost everything described so far. When a central bank raises interest rates, borrowing becomes more expensive. Banks charge more for loans, people take out fewer mortgages, businesses expand more slowly. When rates drop, the opposite happens. Borrowing gets cheaper, loans multiply, and more of that digital promise-based money enters circulation. This single lever, adjusted a few times a year in quiet meetings, ripples out into nearly every financial decision you make. Your rent, your car payment, the price of the coffee you bought this morning, indirectly shaped by supply chains financed through credit. Have you ever wondered why a small percentage change in a distant meeting room can feel like it touches your entire life? Now you know why. Here's the part that tends to stop people cold once they understand it. Your $4,000 is not stored anywhere in the way you picture it. It exists as a series of digital claims, verified and re-verified across a web of institutions, all resting on the assumption that everyone will not ask for it back on the same afternoon. And yet you trust it enough to keep working, to keep depositing, to keep swiping your card without a second thought. Maybe that is the real twist. Not that banking is secretly a trick. It is more that modern life runs on a kind of shared belief so deeply embedded that it stopped feeling like belief at all. You do not think of money as trust. You think of it as fact, solid, countable, real, but peel back the layers, and what you find is closer to an agreement millions of people quietly renew every single day, most of them without ever realizing they are part of it. So the next time you check your balance and see that number sitting there, calm and certain, remember what is actually underneath it. Not a vault, not a stack of bills with your name on it, a promise built on centuries of trust running quietly in the background of your entire life.